Right. Hello and welcome to one and all. Today we are here for an interesting topic on withholding taxes, where we have the honor of two people on the screen over here, Mr. Ajay Roti and SP Singh sir, who have joined us. Wherein during the next couple of hours, we are going to discuss about the controversies and the practical aspects on the withholding taxes. Right. So I would like to give a very brief introduction of the advisor of the Committee on International Taxation, SP Singh sir. He's an ex-IRS with more than more than 2 years, 2 decades of experience, wherein he has supported on various treaty negotiations, the formation of transfer pricing regulations altogether, alongside various MAPs. So he has been a major contributor
The
on the
controversies and the
developments in international tax from the India front. And alongside him, we have Mr. Ajay Roti, who is running a boutique tax and regulatory firm. Again, almost 2 decades of experience, and he has, been continuously advising on international tax, cross-border issues, and is one of the leading names in the industry for these issues whenever we come across. And we have the pleasure of having him with us. And I leave it to SP sir for his opening remarks to open up the topic, and then to for Ajay sir to continue.
Thank you, Rishabh. Thanks for nice introduction. It's a great initiative which has always been taken by the International Taxation Wing of ICAI under the able leadership of Sanjay Agrawal ji and Chitle Saab. We have been holding webinars. It's in the course, it's with the purpose to disseminate information about current topics and which are attracting attention of tax authorities, taxpayers, and advisors. In the chain of those initiatives, today we have a webinar on withholding tax on international transactions, characterization, controversies, and practical aspects. It's a very daunting, topic, and I'm sure Ajay and Rishabh will do full justice. They have to restrict themselves to selected topics or be brief on some of the topics. But it will be a nice experience for all of us to listen to them. And I am really privileged to give the overview of the topic. Friends, withholding tax or tax deduction at source, as we call in India, is a critical tool for preemptive tax collection, securing government revenue from cross border transactions and shaping international tax compliance. In India, this constitutes almost 40 to 42% of the total revenue collected by the government. And we can appreciate the way this is the scope of this provision is being enlarged. There are very few subjects in taxation which match, the broadening of the scope as we are observing in case of withholding tax or tax deduction at source. It was introduced in India in 1920s and was limited only to salaries. And over the years, over the decades, it has expanded very fast. Recent additions reflect, the policy efforts to capture revenue from evolving businesses. Notably, Section 194O was introduced for e-commerce operators, Section 194Q for purchase of goods above a certain threshold, and Section 194S brought virtual digital asset transactions, including cryptocurrencies, under the ambit of withholding tax or TDS. At the same time, existing provisions have been amended to align the tax rates, clarify their scope, and enhance compliance mechanism. For example, Section 194J and Section 195 are particularly worth of mentioning that these have undergone several changes in the recent years to align it with international experience, and to ensure that the right amount of revenue reaches to the government. However, despite these enhancements, practical challenges remain. And I'm sure Ajay and Rishabh will highlight those challenges and try to find out the best way possible to circumvent them or to overcome them. A recurring challenge that all that occurs uh, is that certain payments appear to be falling under more than two provisions, whether it is a business income or the royalty. And this becomes very important because the rate of taxation under two circumstances, the scope of taxation under the two circumstances are very different, and they impact the entire business model which the taxpayer wants to carry on. Beyond classification, taxpayers also face difficulties in establishing treaty eligibility. And the first thing which comes to my mind is the tax residency certificate. And the second is the principal purpose test under the MLI. These are the two areas which are very, very, at the top of the mind of taxpayer and advisors. And all these have led to very interesting litigation. And the recent years, there are a couple of decisions which have attracted the attention of all stakeholders. To name the first one is the Engineering Analysis Center, which has held that certain software payments are not royalty under the domestic law as well as under treaties. Similarly, PILCOM, in case of PILCOM, the Honorable Supreme Court has upheld withholding tax obligations uh, in respect of the payments which are made abroad if the income is sourced in India. And similarly, the capital gains issue has been discussed in the case of Blackstone by Delhi High Court in a very, very extensive manner. But the most crucial procedural aspect which draws the attention of everybody is the filing of Forms 15CA and 15CB, which are designed to establish a reporting trail for foreign remittances and confirm that the applicable withholding tax has been deducted before the remittance is made. While these forms strengthen monitoring and transparency, taxpayers routinely encounter significant difficulties. Now, which are the areas? The payment characterization can be complex and at times ambiguous, making it challenging to determine whether amounts should be treated as royalty, FTAs, business income, etc. The differing definitions and the benefits under India's tax treaty network also add to the complexities. Even minor and the responsibility of completing it fully and truly is very essential. Even minor errors in classification or calculation can attract regulatory penalties or increased compliance burden. Variations in documentation standards, frequent regulatory updates, and the need for coordination among various stakeholders all underscore the necessity for meticulous diligence, accurate classification, and timely expert advice when preparing and submitting these two forms. For chartered accountants, tax consultants, and compliance officers, keeping pace with legislative changes, judicial developments, and administrative guidelines is crucial. The evolving landscape requires constant vigilance in advising clients, risk management, and dispute minimization. Furthermore, international trade trends, including the digitalization of economies, changes to treaty frameworks, and stricter reporting rules, demand attention and adaptability. While the broadening scope of withholding tax creates compliance pressure, it also presents opportunities for efficient tax planning, reduction of controversy, and contribution to a robust and equitable tax system. Professionals who master the nuance of evolving withholding tax provisions and reporting requirements can play a vital role in supporting transparency and fairness in international taxation. In summary, the complexity and dynamism of withholding tax, particularly in cross-border scenario, call for diligence, expertise, and proactive engagement. Today's discussion aims to shed light on these issues, highlight practical approaches, and chart the way forward in navigating withholding tax challenges and opportunities in India and around the globe. I would like to express my sincere appreciation for our esteemed speaker, C. Ajay Roti, and our moderator, C. A. Rishabh Agrawal. Both are truly erudite and experienced professionals whose deep knowledge and significant, insightful perspective would greatly enrich today's discussion. We are fortunate to have their expert guidance as we try to understand the complexities of withholding tax on international transactions. Over to you, Rishabh and Ajay.
Thank you, SP sir, for giving a very wonderful overview, spanning across different aspects. Few of, as mentioned by you, few of them will be dealt today, considering the limited time. And I'm pretty sure that Ajay sir will be doing justice to whatever topic he touches. So, without any further ado, Ajay sir, I invite you to take over the session and hit each ball out of the park which you have decided to bat for. So I will leave it up to you, sir.
Thank you, SP sir, and thank you, Rishabh. Uh, I'm not sure of the pitch, but let me try and do the best that I can. I think SP sir
Ajay, you are Gill and Bumrah combined.
Sir, you've actually set the context extremely well. You're almost like my table of content, and what I wanted to cover was known to you, and it's just heartening that I've almost covered most of the things that you touched upon, which were very valid. So what I thought we will do over the next 90 minutes or so, and then we can have some time for questions if needed, is look at what's been the recent trend in cross-border transactions. Why is this important? We will focus only on payments to foreign companies and foreign service providers and non-residents in this. Therefore, what becomes the scope of income? What's Section 195 all about? Then I've broadly categorized all types of payments into two. One is purchase of goods and purchase of services, or payment for services. And in those two big items of FTS, royalty, and thereafter some controversies that are there, and some practical aspects, whether it is relating to 15 CSEB, issuances, like SP sir said, or few other things on 10F, residency certificates and things like that. This is sort of how I've structured the whole presentation. As things are moving forward with evolving global conditions, a lot more cross-border transactions than what we were used to in the past. There is definitely an increased movement of money between two borders, and whether it is capital investment, whether it's for services, transfer of technology, supply of goods, and all of the things. The scope of income for non-resident taxation is also being changing across the globe. It's for another day, but all of you would be aware of what the BEPS project is doing, what the recent changes have happened on Pillar 1, Pillar 2, etc., where how international taxation, which is essentially taxation of any transaction which touches more than two countries, would actually be looked at. Within India, there is clearly an increased, compliance, examination of the compliance on cross-border transaction. There's definitely a closer monitoring by the Indian tax authorities. SP sir did make a very important point on how much TDS contributes for the total collection. In non-resident cases, that becomes even more important because very technically the Indian payer is acting as an agent to collect that money and deposit it into the government. Unlike the domestic payments, and which is a fundamental difference between the domestic payments and international payments. In a domestic payment today, you're paying rent, you're paying for professional services, you're paying audit fees, you're paying a lawyer, you're paying a contractor, advertisement. We all know that it's all covered by different sections with different rates. You really don't need to see anything more from a resident perspective other than the fact that whether the resident has a permanent account number or not, and then you apply the rates as per the sections 194 C, J, K, I, whichever applies. And once the new income tax bill becomes the act, then we look at section 393 there and go by a tabular format of going into serial number 1, 2, 3, and so on. Nothing too much has changed, and that's why I'm not really touching upon any changes that the new income tax bill is proposing, because overall structure remains the same from a TDS perspective. Whereas when you come to international transaction or non-resident payments, section 195, the way it is structured, is very, very different from all the other sections that we discussed. Because 195 actually requires you to withhold tax if there is an income to the non-resident, does not prescribe a rate of tax to say that this is how much you have to deduct. You need to see what the tax liability of the non-resident is, and I'm oversimplifying it, but that's what we're going to cover in the rest of the presentation. Look at really deducting the tax on that India-sourced income, on the tax liability of the non-resident here. Now, insofar as the income tax department and the regulators are concerned, the Indian payer is the first point of contact and the hook through which the non-resident's tax liability can be accessed. Therefore, when there are proceedings on non-withholding, short withholding, etc., the risks and the scrutiny is much higher when it comes to foreign payments than it is on resident payments. We are seeing multiple notices under section 201 where there is questions asked as to why something was made without deduction of tax at source, or if it was deducted via at a particular rate and why a treaty was applied, and so on and so forth. Those are really the aspects that one needs to be very sure and should have documentation to support whatever positions are taken. From types of payment, there could be interest payments for borrowings, and it could be from third party, from related party. There could be royalties, fees for technical services, capital gains, e-commerce payments, and such other things. Capital gains is one aspect that I have not really touched upon in this presentation because this was more of operational payments and operational taxes. What we are looking at is essentially two broad baskets of payments or buckets of payments. One is for goods and the other is for services. When you're making payments for goods, the way you look at those payments, the compliance and what needs to be done from a withholding tax perspective is very different from what you do when you are looking at services. For goods, it could be import of tangible goods, raw materials, components, finished goods, any of the things. You could be importing capital goods, for example, plant, machinery, etc. Or you could be buying off-the-shelf software, and purchase of goods with installation. Or there could be turnkey contracts where there's goods, there's supply of goods, and there's service and installation, all of which will be looked at very differently. And from a services perspective, what we've been seeing a lot is, of course, the professional consultancy services, technical services. We've been seeing a lot of payments for subscription fees for overseas databases, for magazines, for websites and things like that. These are aspects that I will cover in greater detail than the others. The first 4 of them or 5 of them, including software development, IT services, licensing, etc. There could also be services for freight, shipping, etc. for manufacturing companies. There could be maintenance, after-sale support, online services, digital services, cloud computing. There are also payments that, especially in multinational groups where there is a employee stock option plan participation for the Indian employees, the Indian subsidiary could be making payments for each share of the employee stock compensation expenses, which is charged from the foreign parent. There could be insurance payments, whether it is for travel, on-site employees, assets which are used outside India, and so on and so forth. These are, again, like I said, some of the payments that we've been seeing in the recent past, which form a significant portion, but there could, of course, be many more payments, and this is by no means an exhaustive list. Like I said at the beginning, What becomes extremely important when we are looking at a payment to a non-resident or payment to a foreign company is really the scope of income of a non-resident. These are basics getting into when a non-resident is taxable, etc., but becomes extremely important. Is any income received or deemed to be received in India is taxable, and any income that accrues or arises or deemed to accrue or arise in India is taxable. Section 9 lists down incomes which are deemed to accrue or arise in India, and there would be any income through or from any business connection or a property in India, asset or a source of income in India, transfer of capital asset or transfer of shares in India. The most important in 9.1, which we often see, is the 9.1.6 and 7, which is on royalty and fees for technical services. Again, these are two aspects where we will discuss in greater detail, but it's really to see whether a non-resident is taxable or not taxable. And if yes, at what rate and under which section becomes the most important starting point of the exercise when you look at withholding taxes from an overseas payment perspective. How does the section 195 really work? And like I said, there is an absolute and most critical difference between 195 as a withholding section and all other sections, though they come under the same chapter, and most of what applies to TDS or withholding tax would apply to 195. 195 really governs the applicability of withholding tax for payments made by any payer to a non-resident for payments which are chargeable to tax under the Provisions of Act. If something is chargeable in India, is taxable in India, and it's being made by any payer to a non-resident, then 195 comes in. 195, like we discussed earlier, is absolutely crucial for compliance, penalties, etc., because any tax liability on account of short deduction or non-deduction is on the payer, and the proceedings that we've been seeing have always been initiated first on the payer rather than on the recipient company, because the payer happens to be a resident Indian company or an Indian. TDS under 195 applies if the payment is chargeable to tax, like I said, and after considering any provisions of the treaty that's applicable. Any person who is responsible for paying any sum needs to see this, and which payment or payment to whom. It's either to a non-resident or a foreign company. Nature of payment, it could be interest or any other sum chargeable under the Act. Therefore, any sum chargeable under the Act which is paid to a non-resident or a foreign company comes under 195. Whenever you got to deduct the tax at the time of payment or credit, whichever is earlier. Again, need to be very careful on this aspect. It is not while you are making the payment. It could be payment or credit, whichever is earlier. Do pay attention to when you've taken, when you've passed the entry for this in the books of accounts, whenever you accounted the expense, and when there's a credit either to the party account or any other account that it could be, but when that amount has been accounted. There's always another aspect here to check, which is if there's a reverse charge mechanism under GST, what date do you take as when it is payable, whenever you accounted X, etc. You cannot have a situation where for one law you are saying that it was accounted on a particular date, but for TDS, you do the withholding only when the payment is being made. You need to be deducting tax in the period in which either the credit is made or the payment is being made, whichever is earlier. What is the rate to apply? Like I said, this does not prescribe a rate of 2%, 5%, 10%, etc., like 194CJK provides. It just says rates in force, which is whatever is the tax that's applicable to a non-resident on the payment at that point of time. What are the things that we need to be seeing then from a flow perspective? What aspects needs to be seen when? First is you really assess if the payment is being made to a non-resident. Then you need to see if it is taxable. If it is taxable, what is the document that you need to obtain before you determine what is the TDS to be TDS, the rate to be applied, because presence or absence of these documents has an impact on the rate that you will apply. Once you have determined the rate applicable, if it is taxable, if it is not taxable, what are the forms to be filed for processing the payment? None of these payments the bankers would process without the tax compliance being done. This is overall the 5 critical steps that you would have to look at. And from a withholding tax perspective, from a rate perspective, what rate do you apply? Do you go under the treaty? Do you go under the Income Tax Act? And which takes precedence? How do you apply? The first and foremost thing there would be that particular determination, which is the foreign entity, does it have a permanent account number or does it not have a permanent account number? If the foreign entity does not have a permanent account number, then you can't apply the beneficial rates unless there are certain details to be obtained under 37BC, and we will discuss this in a while, are obtained, in which case you can either apply the beneficial provisions of whichever, the double tax avoidance agreement or the Indian domestic law, whichever is better, can be applied. Therefore, you can apply that rate for a company which has a permanent account number, or a company which is a foreign company or a non-resident does not have a permanent account number, but is able to provide the details as prescribed under 37BC. And like I said, we will come to documentation in a bit, but this is more at a very overall level, whether you determine it under the treaty or do you go under the domestic law. If there is no permanent account number and the details required, which include email address, name, address, tax residency certificate, etc., are not provided, then you go and deduct at the rate specified in 206AA, which is 20%, or any other rate which is higher. So the minimum would be 20% under 206AA. So again, just to recap, this being one of the first steps as to what provision do you actually see to determine whether it's taxable or not taxable. The first aspect that you would see is whether there's a permanent account number or not having a permanent account number. If not having a permanent account number, is the basic details and the details as prescribed under 37BC available, not available? That's the other thing that we will have to see. Then we look at the two broad baskets. One is for purchase of goods and the other is for purchase of services. I've taken the easier one first, which is the purchase of goods. Import of goods generally does not attract TDS under 195. If the payment is purely for purchase of goods and it's an offshore supply, which really means the foreign supplier does not have a business connection, permanent establishment, place of business in India. It's an offshore supply. Somebody is supplying the goods which are manufactured outside from outside India. Then the simple thing is that the person does not have an income liable to tax in India, because this is a pure offshore supply of goods which is being made from outside India with no presence in India. The problem comes if the supplier has a permanent establishment in India. If the supplier of the goods has a permanent establishment in India, then tax has to be deducted. Whatever is the applicable tax on the portion of income which is liable to tax in India, tax has to be deducted. Very technically, once there's a permanent establishment, the foreign company is also eligible for a net basis of taxation. Therefore, at what rate do you apply, etc. The better thing here is if there is no permanent establishment, to take that declaration that there's no permanent establishment. If there is, to also make a determination as to what that permanent establishment is, take appropriate declarations and be safe while the Indian company is making the payment to deduct tax, maybe on a conservative side, but to ensure that there's compliance. There could be business connection and permanent establishment risks. If there are dependent agents, there's a warehouse, there are other things that you would need to see. But this really is for each of the transaction to be examined while the payment is being made, to see if the non-resident supplier has a presence in India, which is likely to constitute a permanent establishment. If it is not going to constitute a permanent establishment, then in any case, under the tax treaty, such a sum would not be liable to tax in India, and therefore there would be no requirement to withhold tax in absence of a taxable income. Form 15 CSEB, which are the two forms required. One is an undertaking by the company making the payment. The other is a chartered accountant certificate to be obtained. Is not required while you make the payment for purchase of goods. That payment can be made by providing a declaration for outward remittance in Form A2 to the authorized dealer. With that, you should be able to make the payment for purchase of goods, and there should be no other issues from a withholding tax perspective. So just to sum up, import of goods, if it is purely for offshore supply, which is purchase of goods from abroad, and the foreign supplier does not have a permanent establishment or a business connection in India, should not be liable to TDS. There could be complications where there's a service linked with the supply, there is installation service and things like that. We'll come to that in a bit. This is pure offshore supply of goods with no business connection, no permanent establishment, should not be liable to withholding tax, and will not be liable to, or will not have any other compliance burdens of obtaining a 15CB certificate or filing an undertaking under 15CA. On payment towards services is quite a wide gamut of things. Everything other than what we saw as payment of goods, would get covered under the payment towards services. Now, from a payment for services perspective, leaving the treaty out for a minute, most of the types of income which would constitute or which would come under the payment for services would be under 115 capital A of the Income Tax Act, which is special rates for income earned by non-residents and foreign companies. This would cover any interest income from infrastructure debt funds, government securities, or Indian residents making any payment for foreign borrowing. This has nothing to do with only third-party payments. All related party payments for interest would also get covered here. So 115A governs interest, governs royalty income from use or right to use intellectual property, patents, trademark, etc., and fees for technical services. We'll understand what fees for technical services is, and of course, dividend. So most of what would be outside the purchase of goods come under 115A for non-residents, and the taxability under 115A for each of these is a different rate, which by inference becomes the withholding tax rate under 195 if there is no treaty or if the foreign company is not entitled to a treaty benefit. So for interest received from infrastructure debt funds, there's a special rate of 5%. Distributed income in the nature of interest from special purpose vehicles which are owned by business trusts is entitled to a beneficial rate of 5%. Similarly, foreign currency loan which was obtained between a particular period of time or any interest payable to FIIs, qualified foreign investors, for investments before 30th June. If these investments have been made earlier and payments are happening now as interest in subsequent year, you still are entitled to the lower rate. These are the only ones where a 5% rate is applicable. Otherwise, any interest received from Indian government or Indian concern will be liable to with tax at 20%, and therefore that becomes consequently the withholding tax rate. Similar is the rate prescribed for royalty and FTS and for dividends, which is 20%, except for dividends of 10% taxability if it is from IFSC, this is GIFT City. So you can almost see that 115A has a 20% rate for most of the service payment, which is royalty, FTS, dividend, and interest. Treaties could prescribe something which is lower than this, and those would be available only if there are certain conditions met as regards to entitlement to access the treaty. If the treaty cannot be accessed, or with a country where there is no treaty, then the non-resident is liable to tax under 115A, and the rates that you see on the screen are the rates that will apply from a 195 perspective on withholding. Then we'll move to two large aspects of fees for technical services and royalty. These are two most looked at subjects when it comes to withholding tax and applicability of this on foreign payments from a services perspective. Then section 917, and particularly the explanation defines the term, but 917 actually governs taxability of fees for technical services received by a non-resident. If a fees for technical services is paid by a government in India, then it's deemed to accrue or arise in India. So any fees for technical services paid by a government becomes taxable in India for the non-resident. If it is paid by residents, it would always be taxable, except if the resident uses that services for a business or profession outside India or for earning a source of income outside India. So let's assume that there's a fees paid for certain legal advice to a foreign firm. If the payment is made by a government of India, it is taxable. if the fees is paid for consultancy services by a resident company, it's normally taxable in India with two exceptions. One is if that is for a profession or business outside India, or if it's for earning a source of income outside India. There are a few rulings which say that export income or the customer being outside India and any service utilized to render services to customers outside India would be for a source of income outside India. The customer itself is a source of income outside India. So if there's any consulting fees paid towards export income, then those will be entitled for this exception, and we could get out of that being taxable in India. But otherwise, any payment by a resident in India for FTS to a non-resident would be deemed to be taxable in India. Similarly, where one non-resident pays another non-resident fees for technical services, it would become taxable in India if that payment is for a business or profession carried on in India or for a source of income in India. So it's a reverse of the exception to a resident. So for a resident, every payment that the resident makes creates a tax liability for the non-resident, except in two cases. When two non-residents are dealing with the same payment, which fees for technical services, it would not be taxable in India, except for two cases where there's a business in India or a source of income in India. So two non-residents are, one non-resident A is paying non-resident B a fees for technical services. Payment is happening outside India, invoicing is outside India, accounting is outside India, but it could still have a tax liability in India if one is paying the other fees for in relation to a business or profession in India or in relation to a source of income in India. As per explanation 2 to 916, fees for technical services means any consideration, including lump sum consideration, for rendering of any managerial, technical, or consultancy services. Very wide definition to say that it is any consideration for rendering managerial, technical, or consultancy services. It also includes the provision of services of technical or other personnel. So any fees paid for managerial, technical, or consultancy services, including for provision of people, technical or other personnel, will be FTS. The only exclusions for it are consideration for any construction, assembly, mining, or such other project undertaken by the recipient, or consideration which would be chargeable under the head salaries, which is any individual payments which would otherwise have been chargeable under the tax salaries, not if it is a business income of the recipient. Therefore, as you would see, practically managerial technical consultancy pulls within itself most of what would be for services. Another way to look at it is 194J, which you are used to applying for domestic payments, takes you back to the definition of managerial technical consultancy under 917. Therefore, there's alignment there. What are the key components of FTS? The three things that we saw: managerial, technical, and consultancy. Managerial would be management functions, management of affairs of people. Again, I'm not getting into too many case laws here and making it too technical, but looking at the absolute practical point is that the underlying theme that is coming out is managerial services essentially implies any control, administration, or guidance for business. Day-to-day functioning, managing affairs by laying down policy standard to say this is how you manage things. The adjective, for example, managerial relates to a manager or a management. Therefore, what would be a manager's role? What would a management do? So it by necessarily means it is wider than pure execution. It also has execution, but some bit of planning part of the activity to be done. So managerial is quite wide for us to be looking at what would get covered as fees for managerial services. It would be most of what would be relating to a business where there is something to be looked at, something to be executed, something to be strategized and implemented. Technical, on the other hand, is slightly more narrower than managerial, because technical services, again, requires expertise in technology, knowledge, or skill relating to a technical field. Again, underlying theme coming out of multiple rulings is that these services must involve specialized knowledge. There should be some experience, some skill or experience in a particular area. It could be engineering, it could be architectural, it could be any of these things. These technical services are largely professional services, like I said, engineering, architectural, etc. A mere provision of one standard facility doesn't become technical. This is again coming out of multiple case laws to say that if it is a standard facility that's been provided, it doesn't become a technical service. Today, if you make payment I'm just taking a random example, if you make payment to a telephone operator for mobile services, for any such thing, it is a technical service. They are using a particular technology to provide you voice transmission across places, etc. But it's a standard service. Whether it gets covered under royalty or not, we will come back in a bit. But a pure play technical service cannot be mere provision of standard facility. There has to be some specialized knowledge, experience, skill that is there in rendering those technical services. Consultancy, again, the third aspect becomes extremely wide. Like managerial, it's anything that could be advisory services. It overlaps a bit with technical services, overlaps a bit with managerial services. But consultancy services, based on multiple rulings, the common thread that can be seen is that it involves rendering of advice, opinion, a recommendation. It refers to somebody with an element of expertise or a special knowledge, like a consultant, like a professional who gives an advice in a particular field. That would be consultancy. And consultancy can be with human interface, human intervention. Now, a consultant can provide you advice, but does not necessarily get into execution like we discussed in managerial function. And also another thing that you have to remember is consulting technically and always cannot be a machine. A machine giving you certain things cannot be consulting services, because consulting presupposes that there is some involvement of a special knowledge or a part of a consultant or a professional who's giving advice. So when you're looking at FTS today, look at pure simple domestic law. Any payment being made which has managerial, technical or consultancy services would get covered and would become taxable in India the moment the payer is an Indian company or a resident Indian. Providing personnel to render technical services like engineer, technician, consultants get covered. We just saw the definition. It has a clear thing to say that it includes provision of people. What happens to deputation arrangements? There are case laws which have, on both sides of the debate. This is a very factual thing. Now, today you can come back and tell me that closer to home, most of the practicing chartered accountants will know that if there's an option to come back, a client can come and say that I want my return done, and how do I do it, and give me some service as to how my tax audit has to be done, how my return has to be done, etc. There's a consulting service, there's a consulting involved, or it could be managerial to manage the process of filing your return, or consultancy to provide how a return has to be done. Then it gets under managerial or consultancy services. What if somebody just comes back and says, give me 2 people, I'll pay you per month X. They will come under my direction, supervision. They'll work whatever I want them to work in my office. Now, these are people who could be working in the office. They could end up preparing a return of income. But is your service agreement for consultancy service, managerial service, or is it just to depute 2 people who will work under the direction and supervision of the client? There are 2 different things, and therefore we need to look at the agreements, what happens on deputation arrangement. Similarly, delivering service via technological means, does it become technical? In my view, it will not, because just because you provide advice by email does not change anything by the same advice being given by way of a printed copy. And you could have actually used a printer to even print that, which is again a technical means. So there's a difference between a technical service and a consultancy or a managerial service which is rendered using a technological means or technology. Again, will the use of technology in providing the service be determinative? Will it be different if somebody provides a consultancy using for example, a artificial intelligence tool or a chatbot or a search engine or whatever it could be, as basic a technology or as complex a technology, or are they still providing consulting services? These are things that will have to be seen. These become extremely critical when you're looking at whether a fees for technical services falls under these or not. But the simple thumb rule from a pure domestic definition perspective is that it's an absolutely wide definition. Now, why am I stressing upon the point that it's a wide definition, because if you look at the FTS clause in some of the double tax avoidance agreement, there's a definition which becomes much narrower. We saw that technical service, fees for technical services, payment of any amount for rendering managerial technical consultancy services, including provision of service of technical or other personnel, but does not include salaries. In a make available definition, as we call a make available definition under the under the double tax avoidance agreement, you could have a definition which says that these are the technical services, but which make available technical knowledge, experience, skill, know-how, or processes. This automatically narrows down the definition, because fees for technical services then is not only rendering of managerial technical consultancy services, but such rendering should also make available that technological knowledge, experience, skill, know-how, process, etc. Could consist of development and transfer of technical plans. It could exclude services which are ancillary and subsidiary to renting of ships, aircraft, etc. But this is just a general definition of FTS that with make available clause we pulled out. Therefore, when you're looking at double tax avoidance agreement, you need to see whether it's the normal FTS clause, which is the same as the domestic law, very wide, or do you look at the FTS clause, which has a make available definition. If it has a make available definition, then it really needs to make available technical knowledge, experience, or skill. I will cover a few examples. I will cover one of the case laws which is important on this as to what that make available is. That's a very important aspect when you're looking at fees for technical services and applicability of withholding for those countries with whom we have a treaty where make available definition exists. The fees for technical services definition under the UN model is more or less similar to our domestic law definition, which talks of consideration for entering any managerial technical consultancy services, including the provision of service of technical or other personnel, unless such payment is made to an employee of the person making the payment, or for teaching in an educational institution, or teaching by an education institution, or by an individual for services for the personal use of an individual. Therefore, again, like in our domestic law, there's an exclusion of what would otherwise become salaries. There are some exclusions here. The specific treaties, India, US, India, Canada, use the definition of fees for included services, not fees for technical services, fees for included services. The fees for included services under India, US treaty, India, Canada treaty is payment of any kind of any person in consideration for rendering of technical or consultancy services, including provision service of a technical or other personnel, which are ancillary and subsidiary to application of enjoyment of right property, which is for royalty. And clause B, if you notice, is make available technical knowledge, experience, skill, know-how, process, or consists of development and transfer of a technical plan or technical design. It's a narrower concept than FTS. Is found in Article 12 of the India-US DTA. The difference between FTS and FIS is that FIS does not include managerial services. It includes certain ancillary and subsidiary services related to a property where royalty applies, but it does not include managerial services. Now, why is the make available clause that important if it is present in a treaty? That is because, like I said, it narrows the definition, reduces the number of things which can get counted as fees for technical services / fees for included services. Therefore, it completely determines whether something is taxable or not taxable. So a service could be fees for technical services under 917 definition and therefore liable to tax in India because the payer is an Indian company. But the very same service could, depending on the treaty and depending on whether there's a make available clause or not, be not taxable in the hands of the non-resident in India pursuant to the treaty. Therefore, in those cases, the non-resident can opt for the treaty definition and therefore will not be liable to tax in India, and consequently there won't be a withholding tax obligation cast on the resident company making the payment. The person acquiring the service should be enabled to apply the technology. A mere requirement of a technical input by a person providing the service does not necessarily mean that the technical knowledge is made available. If you use a product which has the technology, that can't be considered to make the technology available. So I give you a phone and you use the phone. I have not made available the technology of how the phone works. You can use the product. The product has a technology, but I have not made available that technology to you. The case of development and transfer of technical plans, design, technology available may include engineering service, architectural service, computer software development, etc. These all come out of the India-US DTA has a memorandum of understanding, and reading of that is important. There are tribunal rulings which have held that the explanations as provided in the MOU to the India-US DTA should be equally applicable to all other DTAs India has entered into where make available criteria is provided. So the India-US MOU has various examples. I've just taken 2 examples to drive home a point. One, the MOU clearly says that a service becomes a make available knowledge or skill if the recipient can apply it independently. A mere benefit from that service is not make available. So I got a benefit out of the service, it doesn't become make available. The service recipient should be able to apply that independently. The recipient must be enabled to use the technology themselves in the future. Example 3 and 4 relate to the same product in the MOU, and I would strongly urge all of you to read all the examples that are there in the MOU to the India-US DTA, which explains how fees for included services to work. Example 3 talks of a wallboard manufacturing company where they have a particular method of producing more durable wallboards. Therefore, the US engineers train the Indian engineers in a new method as to how that durable wallboard can be produced. And that knowledge transfer empowers the Indian engineers when they come back to use that to manufacture durable wallboard. Therefore, the MOU says that this makes available a technology which can be applied independently by the Indian company in future. Therefore, the fees paid by the Indian company to this US company for this training the Indian engineers in a new method of producing the durable wallboard becomes fees for included services. Now, the next example talks of a contract manufacturing. The Indian company sends all the raw materials needed to the US. The US manufactures the actual wallboard abroad. No transfer of technology, no skill, no know-how to the Indian company. The US company sends the wallboards back. Even in this case, the Indian company has got the durable wallboard with a new technology which it can sell, from which it can profit. But the payment made is for contract manufacturing that does not make available the technology. The Indian company cannot apply it independently. Therefore, that payment will not be fees for included services. Very crudely and very, simply put, this is the difference between buying a fishing rod and somebody teaching you how to fish. Are you able to do something independently? Then that person has made available technology to you. In which case, even if there is a make available definition, it applies and therefore it will be taxable in India because the payer is an Indian company. If you cannot apply that technology independently, then there is nothing that is made available to you. The fees that you pay, the services that they provide does not make available a technology to you, and therefore it will not be fees for included services. Like I said, I would strongly encourage everybody to go through the India-US MOU in greater detail to see, what are the examples, what other things are there, and thereafter you can apply this based on some of the ITAT, and there is a AR ruling also which says that what is provided in the MOU should be applicable to other DTAs that India has entered in order to interpret what that make available is and whether make available criteria is met or not. There's one ruling which is important, and you could look at this. There are multiple others on make available, but I've just chosen to discuss one of those, which is Sandvik, Australia. There's a group company. The services that they were providing were IT help desk, administrative maintenance, and network support services to the Indian group company without transferring any technical know-how, enabling them to use such technology. The Australian company was being made payments and the Indian company was getting IT help desk. So therefore, if there was some maintenance, network support to be done, some installation to be done, some repair to be done, some support to be taken, IT help desk is needed, some emails is not working, you reach out to the Australian team, they do whatever has to be done, and then they provide the support for you to get going. The AO, DRP, all of them treated the payment as royalty fees for technical services, citing there's a transfer of knowledge and there is in the agreement, and that the Indian company is getting a benefit and there's make available of technology that's being done. The tribunal has held that under 12(3)(g), tax applies only if technical knowledge, skill, or know-how is made available to the recipient. Very categorically said, meaning that they can apply it independently after the service ends. In this case, no such transfer occurred. The payment, though technical services under domestic law, were not taxable in India under the DTA and could not be treated as royalty or fees for technical services. This is one of the most important aspects that you need to remember as you look at fees for technical services. It does not end the moment it is technical, managerial, etc., and taxable under the domestic law. You need to see the treaty, whether it is taxable under the treaty, not taxable under the treaty, and thereafter take a call on whether there is a withholding. There are some treaties where there is no fees for technical services clause. Mauritius, Philippines, Thailand, UAE, etc. There is no fees for technical services clause at all. Then what happens? If you have made a payment under the domestic law, it is taxable because fees for technical services is very wide. Let's assume you made payment for certain services. It could be for technical or consultancy. But the treaty does not have a clause. Then can you take a position that without a permanent establishment, there is no tax in India and therefore no withholding? Because unless there is a permanent establishment, then anything in the nature of business income ought not to be taxable. And with no PE, then it's not taxable and therefore no withholding. Or would you see other income article to say if an income is not covered under any of the earlier heads, which includes business, and if it is not covered, then you look at where it is taxable. And in a lot of these treaties, other income is taxable in India if the payer is in India. Then therefore, does it become taxable? Or do you simply say it gets governed by the domestic tax law? And because FTS is not present in the treaty, but FTS is there in the domestic law, and therefore it ought to be taxable under the domestic law, and therefore withholding has to apply. There are a couple of rulings. I would say that the first ruling, which is ABBFZ LLC, which is the Bangalore Tribunal ruling, lays down, in my view, the better position in law and a more sustainable position according to me, which is to say that the absence of the provision in DTA is not an omission, but it's a deliberate mutual agreement. Therefore, the two countries may not have wanted to classify any income as fees for technical services for taxation. Therefore, the intent for not incorporating any provision is not to tax the income under that category. In such cases, you can take a view that if there is no FTS in the treaty, and the non-resident is getting in the nature of fees for technical services, consultancy, managerial, etc., it ought not to be taxable. There is a contrary ruling of the AR in Lanka Hydraulics, which says that such income would then be covered under the article dealing with other income as opposed to business profits, and therefore not being taxable. There are also a couple of other rulings. There's one techni-skill ruling which says that it is not taxable. There's also a TVS electronics ruling of the Chennai Tribunal, which again says that if technical service is not mentioned in a particular DTA, then it could be business income, and therefore it will not be taxable. What we've seen, and this is more for guidance to do a more deeper examination, like I said at the beginning, taxability of just FTS by itself can be a a complete session rather than part of all the types of payment made to foreign companies. A simple FTS definition where FTS and equipment royalty is dealt together are treaties like Germany, Japan, Denmark, Austria, Belgium, China, which are there. There's a separate article for royalty and separate for FTS in certain treaties. There is no separate article for FTS, nor is it covered within the definition, which really means there's no FTS clause, which is what we just saw. That is in some of these treaties, including Mauritius, UAE, Thailand, Brazil, etc. FTS is taxable, or FTS becomes taxable in India only if it makes available a technology. Those are the definitions which are there in US, UK, Australia, Canada, Finland, Netherlands, and Singapore. I would suggest that these are very important treaties for you to remember because these are what's called a narrower definition of the FTS. And in some of the treaties, including US, UK, and Canada, the FTS definition only includes technical and consultancy and not managerial services. The next category is those which includes the most favored nation clauses in the treaty. Say Netherlands and Switzerland, for example, says if there are any treaties after we've signed and it has a narrower definition, then you could borrow that. Therefore, for France, Sweden, etc., we actually borrow definitions of make available or of from UK or of technical and consultancy for some other treaties and things like that. So the treaties which have MFN clause in for FTS also becomes extremely important. There are some treaties where FTS is defined similar definition to the Act. Beneficial ownership is missing in certain treaties, which is not really none of the treaties which we use very often. In US and Canada, like I discussed, FTS is actually characterized or named as FIS. These are aspects that one had to remember if it was fees for technical services. Now I'll quickly move on to royalties. Again, another large topic on different types of payment. This chart more or less is the same as what would be on taxability for FTS. If a royalty is paid by the government, it's taxable. Royalty is paid by a resident is always taxable, except if it is a sources outside India. Royalty paid by one non-resident to another non-resident is taxable in India if it pertains to a source in India. What constitutes definition of royalty? Transfer of rights in respect of a patent, invention, design, secret formula, process, or a trademark. Imparting information about working or use of a particular intellectual property. Any payment for use of such intellectual property. Information concerning technical, industrial, commercial, scientific knowledge, experience, or skill would also become royalty. Right to use industrial, commercial, scientific equipment. So this is what is very often called as equipment royalty, which is you pay to use an industrial, commercial, scientific equipment, it becomes royalty. Transfer of rights in respect of a copyright, literary, artistic, or scientific work, including films, videotapes for TV or radio, and rendering of services connected with any of the above activity. All of these become royalty. And there are some definitions, some changes which has been done in the domestic law. The most important one being the domestic law includes transfer of rights to include any right to use or license a computer software, irrespective of transfer medium. I'll tell you why this is such a big thing. That at the beginning of the session, SP sir talked of engineering analysis case, and this is linked a lot to that particular case. Royalty also includes consideration for rights, property, information, regardless of whether the payer has possession of the control or not. And the payer uses it directly, its location is in India, then it's covered. Process includes, and the amendment made clarifies that it's always included transmission via satellite, cable, fiber optic, similar technology, whether it is secret or not. These are again outcomes of rulings which had held that if you transmit via satellite, cable, optic fiber, etc., it does not amount to right to use the equipment because you have no control and it's not a secret process. But these amendments have been made now to include the transmission of anything via satellite, cable, etc. will be royalty. Transfer includes the right to use or license a computer software, but these are definitions under the domestic law. Under the domestic law, the royalty definition clearly has wider import where software is also included, and transmission via satellite, cable, optical fiber is also included. That's not the case with the treaty definitions in most cases. What all are covered? Intellectual property and knowledge. It is payment for use or right to use a copyright of literary, artistic, or scientific work. Therefore, a copyright of scientific work is covered. Films, work on films, tape, etc. Patent, trademark, design, models, all of it. And one is industrial, commercial, scientific equipment. The other is any knowledge relating to information concerning industrial, commercial, or scientific experience. That also gets covered under royalty. All of these includes gain from alienation of such property if the gain depends on productivity, use, or disposal. Therefore, it can be a lump sum payment at times, but it can still be a royalty. Royalty clearly includes payment for use or right to use any industrial, commercial, or scientific equipment and does not cover, shipping, air transport, and we leave that for a minute. What happens between the DTA and royalty as per domestic law? Because the DTA definitions are slightly different. Again, like fees for technical services without make available in domestic law and with make available in domestic law, the definition under the treaty could be a narrower or a restricted definition. The Income Tax Act in 916 uses or taxes as royalty, use or transfer of patents, trademark, design, secret formula processes. That is similar. Imparting technical, industrial, commercial, or scientific knowledge is also similar in most treaties. But scientific equipment does not include transmission by satellite and all that in most of the treaties. Again, services connected with the above is mostly covered in most of the treaties. Like we saw in some of the treaties while we were looking at FTS, any services related to some of the royalty payments will also be covered. What are some of the key controversies which have been there until now? Really, the biggest one has been whether payment for purchase of software by residents amounts to royalty or not. So this was a huge batch of matters, multiple companies, thousands of cases which the Income Tax Department had pursued over the years. The whole point that the Income Tax Department built their case on is to say that when you are paying for a software, you are actually getting a right to use a particular copyright, a particular intellectual property, and therefore that amounts to royalty. Firstly, the Karnataka High Court in a batch of cases, led by Samsung, and the Samsung decision held that payment for purchase of software is royalty, and therefore if an Indian company is purchasing software, it amounts to royalty and therefore tax has to be withheld. Delhi High Court was taking a contrary view in Ericsson and a set of cases to say that it was not royalty. The matter went all the way to Supreme Court. Multiple, taxpayers, a large batch of cases. Lead one was engineering analysis, and that's the decision we keep citing very often now. It's been followed. It's the law of the land. The Supreme Court grouped the appeal into 4 different categories basis the characteristics of the payment made by Indian parties to foreign parties, because the engineering analysis batch also had a lot of software distributors such as Sonata, original software companies which were licensing to direct end users such as Microsoft, and so on. There were also other distributors who were obtaining the right from a foreign distributor. So those were also covered. So the 4 types of payment which the Supreme Court batched, characterized, and covered was 1, purchase of software by resident end users. So you and I buy software and we make the payment. Today we can use Microsoft Office, Word, whatever, and what happens? Purchase of software by a resident distributor, reseller for sale to resident end user. So Microsoft is selling software. There's an Indian distributor who purchases the distribution rights of the software or software to distribute does not use the software, distributes it to me and you, what happens? Similarly, third was purchase of software by resident distributors or resellers from a non-resident distributor or even an end user. So in the first case, I as an end user purchase from Microsoft directly. Second one, I actually buy a particular software which is not sold directly by the company which has made the software, but there's a distributor in a country outside India and I buy it from them. The fourth was purchase of software which is embedded in hardware sold as an integrated unit. This could be phones, this could be other equipments where there's a software in the equipment that you purchased. You actually purchased the hardware, but you've also got the right to use the software which is loaded on that hardware. These were embedded softwares. So there was software by the resident end user, software purchased by resident distributors, and software purchased by anybody from a non-resident distributor. These were the three categories, and the fourth was a embedded software. The Supreme Court examined multiple things. Really, the question was, is computer software a copyright or a copyrighted article? Copyright is an exclusive right which includes the right to restrict others from doing certain act. Ownership of a copyright in a work is different from ownership of the physical work in which the copyrighted work may be embodied. A copyright is said to be transferred if the right to do any of the acts in section 17 is also transferred. Access to use the licensed computer product without any exclusive right is not parting of copyright and same cannot be regarded as royalty. Now, the simplest way that I have understood this always is take the case of you going and buying and people of my times buying a cassette or buying let's say a book today. If you buy a audio cassette, you get to hear all that is there on the cassette, all the songs which are there. You bought a particular copy which is owned by you. That can't be taken by anybody else. That cassette belongs to yours. But it comes with a lot of restrictions to say you can't publicly broadcast it, you can't use it in a radio station and so on. You can't make copies. Just because you bought one cassette, you can't make 100 and sell it. So what you bought is a copyrighted article and not the copyright itself. And similarly, if you today buy a computer software and go back a while, you used to buy the software in shrink wrapped boxes. You could open the box, put a CD and load the Microsoft Word, for example, on your laptop. You could use it. That copy was yours. But could you make 100 copies of that on another CD and sell it as Word? No, you could not. Therefore, what you got an access was for that licensed product to do what you want with it. But you cannot get a license to transfer it. So therefore, a non-exclusive, non-transferable license merely enabling the use of a copyrighted product cannot be construed as a license to enjoy all of the rights. The right to reproduce and the right to use are very distinct and separate rights. So I may get a right to use, I'm paying for that, but I'm not getting a right to reproduce. Therefore, the fundamental difference between the right in a copyright to a right in a copyrighted article was seen. Supreme Court said section 14 makes it very clear that a copyright means an exclusive right to do or authorized any of the act in respect of a work. 2M provides for definition of infringed right, which makes it clear that for a computer program, an exclusive right would mean the right to reproduce a computer program and exploit the reproduction by way of sale and transfer of license. So if I bought a computer software and the source code owner said, you are free to make as many copies and sell it for money, that is different from that person selling me the right to use that particular copy. So even the OECD commentary states that the right in relation to a copy of a software just to enable effective operation should be disregarded in analyzing a character. Now, could somebody have said that you have a right to copy because it comes on a CD and you can copy it onto your hard drive? That's where they said that if it is in relation to making a copy only to enable the effective use, so I can't use it on a laptop on the CD, so I copied it onto my laptop hard drive and I'm using it, that does not make it as a right for you to get copying rights. OECD commentary also stated that rights acquired by a distributor to distribute the software should be disregarded in analyzing character of the transaction. Again, the Supreme Court analyzed analysis of sample of EULA and distribution agreement. EULA is end user license agreement, which is what does an end user get when he buys a software. And they clearly held that what is granted to the distributor is only a non-exclusive, non-transferable license to resell the computer software. It's again said that no copyright in the computer program is transferred to the distributor or the end user. Therefore, the Supreme Court clearly held that license that is granted is not a license in terms of the Copyright Act, which transfers all of the rights in that license, but it is a license which imposes restriction on the conditions for the use of computer software. So even though Government of India had expressed its reservations on the model commentary, etc., and they had amended the definition of royalty under the domestic law, the Supreme Court said that this is how the license has to be read. The report of the Committee on E-commerce Transaction, which the revenue placed reliance on, was a recommendatory report which the Government of India may or may not accept. And the Supreme Court further clarified that even if a report is accepted, a DTA will have to be bilaterally amended to give effect to that. So you can't unilaterally amend and use it. The other argument that the department advanced is one to say, yes, it is royalty and therefore it is liable to tax in India, and therefore the Indian payer ought to have withheld tax on this. The revenue argued that the provisions of withholding are distinct apart from the provisions of assessment. They placed reliance on the decision of Transmission Corporation to say that the payer under 195 and SSE under the income tax are distinct. Placed reliance on PILCOM ruling to say that tax should be deducted even when tax was otherwise not payable by the non-resident. The Supreme Court, relying on the earlier GE India Technology Center, held that the deduction of taxes in respect to non-resident applies only when the charging provision read together with the DTA apply. So the court, they also held that PILCOM was on a completely different provision, and therefore that does not have an application to this case. Therefore, this is an extremely important principle laid down in addition to, the software ruling. The engineering analysis furthers what was held in GE India Technology Center to say that 195 applies only if the non-resident is liable to pay tax under the Indian Tax Act, read together with the DTA. Extremely critical and important. Therefore, if a payment to non-resident is not liable to tax under that, then you don't need to worry about withholding tax provisions. At this point, the long pending issue on withholding on overseas payment software is settled. The Supreme Court has also said that PILCOM will not apply. The Supreme Court has also stated even if the recommendation of the e-commerce report are accepted, then DTAs have to be bilaterally amended. So if there is a DTA and that DTA has the definition of royalty, which is not expanded like the Indian domestic law definition, then today any payment for purchase of software, which is we are seeing quite commonly happening these days, should not be liable to tax given the engineering analysis decision. The next important decision that based on the different types of payment and the more number of payments that we are seeing is the recent one on cloud computing services, etc. What happens to that? So we are covering some of the things which are very common, not getting into every payment for foreign companies. Cloud computing is something we've been seeing a lot. The department also has been holding a position that cloud computing services would be royalty because there is use of or right to use a equipment or a process. The Delhi High Court examined this in the case of Amazon Web Services recently, whether AWS computing services paid by Indian residents become taxable, whether it amounts to use or right to use equipment or process, and therefore does it become equipment royalty because there's equipment that is being used, whether it can get then classified as fees for technical services because there's some technical services coming, or what happens under the US-India DTA. In this case, AWS, a foreign company, tax residents of USA, was providing a standard automated cloud computing services globally. You or I could log in, subscribe for that service, and get a standard electronic contract with AWS. And with hosting and bandwidth charges, we could subscribe for that. The whole proceeding was initiated when Snapdeal made a payment and AWS received this income without TDS. The assessing officer of the opinion that the income is taxable as royalty under the provisions of 916. also taxable under the royalty under India US DTA. AWS did not file returns and the proceedings were initiated against AWS. The revenue contended that the SSE is providing a highly technical service and supports its customers and also makes available technology. Thus, the impugned receipts are taxable as FTS under the Act, FIS under the India USA DTA. You need to remember FIS, India USA DTA, does not have a royalty definition separately. It is subsumed in the FIS definition. The service offerings of the SSE also cover the AWS mark, trademark, service marks, logo, and other designations. The trademark use guidelines provide the customer the permission to use AWS mark in connection with use of services. Accordingly, the SSE is providing copyright and trademark to its customers for commercial exploitation and sharing information concerning industrial, commercial, scientific use, which qualify as royalty. This was a very interesting argument because it basically said if you're using an AWS service, you as a customer can say this is powered by AWS or I'm using the AWS service. For limited purpose, you are provided the right to use that AWS mark. Now the department said that amounts to royalty because there is a right to use the copyright or a trademark which belongs to Amazon Web Services. The AO therefore concluded that charges received by the SSE for cloud computing would be taxable as equipment royalty, and that the payment made by Indian entities to SSE for cloud computing services would be therefore royalty and tax has to be withheld. What did the SSE argue? The SSE said that cloud computing services provided are standard and automated services. It's publicly available to anyone. So therefore, there is no non-transferable license. There's nothing that is secret process about it. There's no, there is no copyright or anything, and the source code would never be shared. So nobody knows how that works. Customers do not receive any commercial right or copyright or any other thing involved in AWS services, only get a right to access and use the AWS service themselves. Therefore, the consideration should not be regarded as copyright and right to use a copyright or even equipment royalty. They relied on certain other decisions which are already held that cloud services and standard services, technical services provided by companies ought not to be treated as equipment royalty or royalty. High Court again said that customers can access and use the cloud computing service, but they do not acquire any right or title or any IPR that would entitle them to exploit or commercially monetize the assets. Therefore, it will not be equipment royalty. It will not be royalty. Then they also said it's not equipment royalty as customers do not get any right to use the infrastructure or software for commercial exploitation. The payments are only for availing services, not for using the equipment or IPR directly. SSE uses its own proprietary equipment and delivers service. No equipment or intellectual property is transferred to customers. Therefore, it does not qualify as royalty. Then they also said it does not transfer any skill, knowledge, technical process, etc. because the SSE has developed that infrastructure and it permits the customers to just access that. There is nothing that they are giving to the customers and therefore it should not be royalty. Again, given the amount of cloud services, online subscriptions for software that we are seeing, this is an important principle that's been laid down by the Delhi High Court. AWS services would now, you can take a position that there should be no withholding. These don't amount to equipment royalty or any other royalty for that matter. The third aspect that we wanted to discuss is, again, payment for subscription of online databases or access fees that were there. As you know, Gartner runs one of the largest database research analysis software and products where you can just subscribe and get access to a lot of databases and data that is there by way of a subscription or access fees. The Karnataka High Court in Wipro had held that the payment for Gartner online databases is liable to tax TDS under 195 because it amounts to royalty. There was a Mumbai tribunal ruling in SolidWorks Corporation which held that they were business profits and therefore not royalty. Karnataka High Court, the tribunal has now said that the Karnataka High Court dealt with the exact same SSE and transaction from payer side. and the tribunal cannot take a contrary view to the High Court ruling, and has held that subscription fees are taxable in India as royalty both under the Act under the DTA. This again is an important ruling and a principle to be borne in mind while you are looking at withholding tax on online subscription and databases. This is important even for practicing CS when you're issuing certificates today, to be aware that this is one of the rulings which is now been applied twice over and for online subscription. We'll just now move to some of the practical aspects on actual documentation and compliances rather than the substantive aspects of taxability and whether an amount becomes taxable or not taxable. The most important aspects as you start looking at after you've determined taxability, whether it's FTS, royalty, etc., and then whether you can apply a treaty, which definition you take, is the 206AA, which provides that if a payment is being made to a person who does not have a valid permanent account number, tax has to be deducted in rates in force, rates provided in the Act, or 20%, whichever is higher. The Rule 37BC carves out an exception to say that 206AA shall not apply if the non-resident provides name, email address, contact number, address of the resident in the country of residence, a tax residency certificate, and a tax identification number in the country of residence. Therefore, the following documents are very important to be collated from the foreign entities for computing of withholding tax rate. If a tax residency certificate with an electronically generated TNF is required and that has to be obtained, most of the details that are required in 37BC will be available in these documents. If there is a permanent establishment in India, then the rates in force changes significantly. Therefore, we also recommend that obtaining a no-P declaration in all cases, because what is the higher of the things completely change if there is a permanent establishment in India. Therefore, today, a tax residency certificate and an OP declaration has almost become the most basic requirements required for any of the withholding tax obligations to be met in respect of a foreign payment or payment to a non-resident company. There's always an option to make an application under 195(2) at the time of payment to determine whether such a sum is chargeable or not chargeable, whether the whole sum is chargeable, what should be the tax that is to be withheld, etc. And this, from a practical perspective, is a risk-free option, reduces the risk in future. If there is a question on non-compliance, you made the payment, obtaining a 195 order, which clearly says that whether tax is deductible, not deductible, and if deductible, at what rate it is deductible. In case of doubt, in case of any payments where there's ambiguity, applying for a 195(2) would be recommended. Is it obligatory to approach the AO for non-withholding? Once a sum is ascertained, even partially chargeable in tax in India, unless an order is obtained, you still may not have tax liability if it is not taxable. Therefore, it's not obligatory or it's not mandatory. You can always go under GE India Technology Center or the engineering analysis to case to say that if it is not taxable, then there's nothing nothing to be withheld. Is the order passed under 195(2) conclusive, and can department take contrary view? It's definitely not conclusive, because the 195(2) is a provisional assessment given, but it does protect you from penalty and other implications at a later point of time. But the department very well can take a contrary view while they are assessing either the foreign company or looking at a 41 disallowance in the hands of the Indian company making the payment. They can take a contrary view to say that a 195(2) issued and the view taken there is not a final view and does not apply always. There are a few other issues on 195(2). Very quickly going through some of these things, whether an order passed under 195(2) is it appealable? Can it be challenged before higher authorities? Yes, an appeal can be filed under 248, where tax is borne by the taxpayer. A revision application can be tried under 264, or you could even look at a rate in certain cases. Of course, there has to be a case to be built for you to invoke the rate jurisdiction. There is no time limit that has been prescribed for passing 195(2). there are guidelines internally issued for certificates to be issued within 30 days from the end of the month in which the receipt of application. We've not seen this followed very strictly, but there is definitely no legal timeline for making the for the officer to respond on an application made under 195(2). What is required for processing of the foreign remittance? This becomes extremely critical. After you've determined all of it, there is a paperwork to be done. The remittance to a non-resident requires furnishing of an undertaking in a 15 CA, accompanied by a chartered accountant certificate in 15 CB. A 15 CB shall be issued accompanied with the UDIN always. So the 15 CB is issued by the chartered accountant to say that whether tax is deductible or non-deductible, for which party, what is the payment, date of payment, etc. After that, a 15 CA is generated to be tagged with a 15 CB to be submitted to the authorized dealer for processing. As per 15 CA format, it's segregated into 4 parts. Part A is applicable for remittance of sum chargeable to tax and aggregates of such sum does not exceed 5 lakh rupees during a year. Part B is where a lower withholding order has been obtained. Part C is where the remittance or aggregate of sum exceeds 5 lakh rupees and 15 CB is required and you obtain a 15 CB. Part D is where a 15 CB is not required and there's no withholding. So part A below 5 lakh rupees, part B is where there's a lower withholding, part C is where TDS is to be done and a 15 CB is required, part D is where TDS is not to be done and 15 CB is not required. Practically in our experience, part A very rarely do authorized dealer accept. They've been insisting on filling up of C or D as the case may be, where part A applies if it is liable to tax, then to go under part C and fill up the details. From a summary perspective, check whether a payment is chargeable to tax. If it is it greater than 5 lakhs? Yes. Do you have a lower withholding? If you do, go under part B. If you don't, part C. If it is greater than 5 lakhs, if it is not, then you go under part A. If the payment is not liable to tax and it is specifically excluded, such as payment for purchase of goods, etc., you go and file a part D where a 15 CB is not required. After you've done withholding, you've remitted the tax within the prescribed period, which is 7th of the following month, except for the month of March, where you have time till April 30th. You prepare a ETDS return. All transactions with foreign entities which require withholding is to be reported on a quarterly basis. 27Q is to be filed every quarter. The consolidated 27Q for all the associated enterprise or related party and third party payments. You need to consider all your returns in that quarter. TDS return is prepared. The due date is the last date of the subsequent month of every quarter. So for the quarter ending March, it's 31st May. And for the quarter ending September, it's October and so on. Post the return is processed by tracers, a request is raised for generation of 16As. Because a lot of the times the foreign vendors ask for proof for tax reduction or choice whether to get a foreign tax credit in the other country or if they have to file their return of income. You can issue within 15 days from the end of the month in which the return is filed, and you can you can generate the form 16As to be sent to your overseas customers. There are a lot of practical challenges that we've faced. We thought we'll highlight the top 4-5 of them more for just sharing our experience. Some of this we may or may not have clear answers. The form 15 CB, which is to be filed by the chartered accountants on e-filing portal, and a UDIN is generated, can be revoked only within 2 days. We've seen cases where of 15 CB is generated, the exchange rate changes, the amount of payment changes, and things like that, or any other details changes, then it can be revoked only within the 2 days of submission. Otherwise, it just goes as an unutilized form 15 CB. It just stays there. You need to create a new 15 CB. In cases where there's an error generated in form 15 CA, which means a 15 CB is filed, the 15 CA is filed by linking the 15 CB, and there are some errors in the 15 CA. It could be party name, address, country, multiple other things it could get wrong in the 15 CA. If the 15 CA is rejected because of an error, then the 15 CB also automatically gets treated as consumed, cannot be revoked, cannot be used. So if you tag a 15 CB to a 15 CA and submit it and it gets rejected, then you need to do your 15 CB once more. And a fresh 15 CB needs to be issued and needs to be tagged with the revised 15 CA after the correction. There are a lot of issues that we've faced on Form 10F to be generated electronically, especially in cases where non-resident directors face difficulty in generating OTPs. We've particularly seen problems with non-residents in Mauritius, China, etc., where OTPs don't reach. Therefore, we are having trouble even generating 10Fs in those cases because you can't validate it. We've seen cases where there's a number in India that is used and things like that. We just need to figure out a way to do this, but there have been some difficulty in generating OTP, especially in certain cases. In some countries, UAE is just an example. Tax residency certificates are issued after completion. So today you can't apply in UAE to get a tax residency certificate for year 25 because it's not complete, and they won't give a futuristic tax residency certificate to say that for full year you'll be a UAE non-resident. They only issue after you've completed the period. Whereas today you're making the payment, you may need a tax residency certificate. We've seen tax residency certificate issued by UAE as on date, which confirms the last few months to be resident, and you could use some of those and take declarations, etc. There are issues that we've seen where there is certain inconsistency amongst authorized dealers, the bankers. They have different views on certain things, including on what is the purpose code to be used for the type of payment in 15 CB to be taken by the chartered accountant. We've seen them reject, send back for change of purpose code and things like that. There are no set consistent positions being taken by authorized dealers, but this is something, again, you have to be aware. As a practice, what we've been advising clients and what we've been doing is to get a confirmation from authorized dealer as to if all of this is okay, rather than get everything rejected after filing, and it just delays the foreign payment after having decided on withholding and all of the things. Therefore, this is one other aspect that we have seen. These were some of the practical difficulties that I thought we should just highlight. But if there are more, happy to take some questions. We can have some discussions if the people want to share some of the other issues, practical aspects that they would want to highlight. Rishabh, if there's, I think we have another 15-20 minutes if you want to take some questions. I'll just stop sharing my screen.
Right, sir. Sir, I've shortlisted the questions from the participants, which will help the larger audience in general. So I'll take those up.
Sure.
Amit, I will take the specific questions also. Right? Sir,
Sure.
the first question was relating to the software payments again in the context analysis. I think it's more of a confirmation that irrespective
Rishabh, your voice has been going breaking in between. I'm not able to hear you at all.
of software or only in
Rishabh, I couldn't hear that. We are in a bad connection, not able to hear at all.
is it better now, sir?
Yes, it is better now.
So the first question relates to engineering analysis, sir.
Yeah.
Wherein purchase of software, the question is that only with respect to the DTA, there is no TDS, or reading the domestic law plainly is also there is no TDS.
It's only with the DTA, because on the domestic law, what has happened, Rishabh, is they have amended the law to include any payment for use of computer software to mean royalty. Therefore, if non-treaty countries payment is being made for purchase of software, it would be liable to TDS, or even in those cases where we are not able to get enough documents to apply a treaty, and if the resident is not able to establish eligibility to the treaty access, a pure domestic law withholding will be applicable for payment of computer software.
Right, sir. So second, again is a confirmation on the reimbursement, sir. Whether there is TDS on reimbursements or not.
So reimbursement, there's enough now, even in terms of judicial precedents, to take a position across jurisdictions that there is no element of income, and therefore it should not be subject to TDS. But what becomes important, Rishabh, is to collect the documents to establish that there's no element of income. If there is a element of income, which is there's a markup, there's a somebody incurred $100, but they have billed you $105, there is a $5 element of income, then the positions and the rulings which have held that reimbursement will not be liable to tax because of absence of element of income will not apply. What is important is for it to be a cost to cost reimbursement, and for us as payers to have that proof and be able to establish that there was no income element for the non-resident and therefore there's no withholding.
Right, sir. Sir, another, I think the mass question is on the exception in under section 917 clause B uh, for the payments of FTS, where it is not
Right.
liable to deem to accrue, right?
Yes. So that is.
So if you could, sorry,
yes.
sir, please go ahead.
Is there a specific question or general principles on that?
No, sir, general principle, sir.
So from a general principle perspective, Rishabh, it is if a payer is Indian and there is either royalty or FTS, it would be liable to tax in India. The exclusions are if that is in connection with a business outside India of the Indian resident, or it is in relation to a source of income outside India. Now, just to take a very simple example, if an Indian company is making some of these payments for services in relation to its domestic business, it would be liable to tax. If it is in relation to a branch outside India where it's being used outside India, it's in relation to a business that is being carried on outside India, then it will not be liable. There are a couple of rulings, including HEG and few other Bangalore tribunal rulings, which have held that if your customer is outside India, then it's a source of income outside India. So if any services are relating to on-site services in software companies, for example, you have a customer outside India, there's some services utilized outside India, then even if you are making the payment from an Indian company, you can take this source outside India exception and say that it will not be liable to tax in India for the recipient because it is paid by an Indian company in relation to its business outside India.
Right, sir. I think, sir, this sums up the questions that are there on the principle of the law itself. We have some practical aspect questions as well. You have covered most of it, but which were not covered, I'll ask them specifically over here, sir. Sir, first one is in case of purchase of immovable property from a non-resident.
Right.
The buyer needs to apply for a tax account number, so TAN. However, this is a once in a lifetime transaction. So any alternative procedure available under that?
There is, unfortunately, there's no procedure available for that. This is one of those cases where I think it's a good case for some representation to actually ease the compliance on this. But right now you will have to, and without a TAN you can't file a TDS return. And without filing a TDS return, the recipient will not be able to get credit. But if it is purchase of immovable property from a non-resident and the property is outside India, if it is not taxable in India, then there won't be withholding. If it is purchase of a immovable property from a non-resident and the property is in India, then there will be a withholding because of the income being accruing. If income is taxable in India, then there would be a withholding, but there would be exclusions for property related property present, and the withholding is on immovable property.
Right, sir. I think that sums up this specific question. Sir, another question on practical aspect is a lot of times the taxpayer or the SSC directly files 15CA, which is further also, may be accepted or may be rejected by the authorized dealer. Then
Right.
a chartered accountant is approached for Form 15CB. Again, Part 15C, Part C of 15CA will be filed. So how does this work? Because there are two 15CAs for the same transaction now.
See, you can't do Part C without a 15CB because a Part C of 15CA can be done only if there is a reference to a 15CB and that 15CB is already approved.
Right, sir.
So
I think they filed, I think, Part A, irrespective of that, and then
So
Did
I
the
get
correct
that.
procedure?
Yeah, that has been the case that we've also seen in some cases where Part A is filed is taxable, but they have insisted on Part C because it is under that. In which case, then you have to redo everything again.
Right, sir. Uh, I have one more. Okay, sir. In India UAE scenario, fees paid for company incorporation to a consultant in UAE. No FTS, specific FTS clause within the DTA. What is the withholding treatment?
You don't need to withhold because we can take a position that in absence of FTS, whether it amounts to consultancy or managerial services, it will not be taxable in India in absence of a FTS clause in the treaty. For UAE, it is very clear.
And last one, sir. Is there any impact on chartered accountants for any unutilized Form 15 CBs?
We've not seen any. We've been working on this for a while now. There are quite a few unutilized 15 CB for a variety of reasons that will be there. There will be a UDIN. I not seen any questions raised either from the authorities or by the institute or anyone until now. But this is something that, in my view, has to be fixed because you can't have 15 CBs which are issued and I'm just throwing up a situation that somebody believes it is taxable, issues a 15 CB, and then the company decides that it's not taxable, obtains another certificate, tax it, and makes the payment. Then really the value for the first CA who's issued a certificate stating that there was withholding somewhere gets overridden, but that certificate remains unutilized, untagged, and remains in the system. But I've not seen any implications, anything until this point. I've not even seen any questions come for 15 CBs which are utilized, but 15 CA is withdrawn or not used for payment, and then a fresh 15 CB is issued later. Some of these, tying up at the back end or even to see how valid these certificates are, data, etc., I don't think is happening. Should happen at some point, in my view.
Right, sir. So to sum it up, we can say that as of now, no questions asked. As of
Yes.
now, we don't know about later. Sir, since we
That's
have
where it
a
is.
couple of minutes, can I take a specific question that has been put by one of the participants? Maybe a specific situation.
Sure.
So the question goes like destination management agencies outside of India having no permanent establishment in India provide arrangement of hotels, tours outside India.
Right.
From India Tour Packaging Company will make the payments for these services. As of now, no TDS being made, claiming the exception.
Right.
So what kind of a confirmation, sir? I leave it up to you. If you
No,
wish
I
to
think
answer.
that is, in my view, also the right position with whatever limited facts that is stated as quickly as I could gather. With the facts you stated, if it is for tour services, operating services outside India, it would the presumption would be that it is for their customers, clients who are traveling outside India. And if a payment is being made, yes, at this point, according to me, like I said, with the facts that you've given, a position that there's no withholding is tenable.
Right, sir. I am just waiting another, maybe couple of seconds if any other participant has any question, which we can take up. Otherwise, I'd like to sum up the session. Okay, so one question popped up, sir. Whether on rent for residential property, which is being paid to a non-resident, is subject to TDS again.
It is.
If you could also mention the rate again. So
no, the rate again, it's an individual, so it will be the rates applicable to the individual. It is a normal income. You see, the simple thing is if you are making a payment to a non-resident, even whether it's for purchase of shares, any income that is taxable in India, withholding would apply, and the withholding would be rates in force, which is the rates that apply to the income as computed. So now somebody can ask me if it is capital gains, do I take a computation? We have suggested take a CA certificate computation if you have not taken 195. Same for rent. How do you take the slab rates, etc.? Assume that this is the only income, or do you really take at the highest rate, assuming that there are other incomes? Some of these are calls that we will have to take based on the facts and what our comfort is. Again, I have not seen a case where the department has come down very heavily if due diligence is done by the payer and you are able to establish that there was no malafide and you've done your work, taken the amount of documents that you need to, because you're not end of the day an assessing officer, you won't have the right to collect all information about the income of the non-resident. You would sort of do it based on what information is available with you at that point.
Right, sir. So the basic rule of thumb stays the same. Then we can tweak basis the facts uh, of the case.
My only suggestion, dealing with a lot of these 201 notices, documentation, obtaining supportings. For example, the question on reimbursements, those not having an income here, what slabs do you apply, or computation of capital gains. All of these documentation, obtaining those things, having it on record while you make the payment becomes extremely critical. Whether you look at what practically is happening on ground, the amount of tedious scrutiny that is happening, or the annual plan that the CBDT has put out to the officers, there is an increased focus and increased scrutiny on tedious compliance. And also a lot of these get highlighted because of the disclosures made in tax audit reports, etc. So documentation and having all of these at the time of making the payments become extremely critical.
Right, sir. I think so. With this, the question board is clear as of now, and I would like to invite SP sir for any closing remarks. SP sir, are you still with us?
Yes, I am.
Sir.
Very impressed by the way Ajay has explained the theoretical aspects as the controversies and the points, inferences which can be drawn from those cases. In fact, withholding tax, or the TDS as we call, is a very, very interesting topic, because it is it neither gives the right to tax any income, but at the same time, the compliance of these provisions are very important, because any failure results in interest, penalty, prosecution. So one has to be very, very careful about this. Section 195, as Ajay has rightly mentioned, differs from other provisions. And one of the most significant difference is that, unlike several provisions where the tax is to be deducted on the gross basis, the Section 195 talks about the TDS on the income element of any transaction, which makes it totally different. One has to go first in depth about whether there is an income element or not, to what extent there is an income element. Now, very important, because they become, one limb of the tax department, as on the basis of the certificate issued by the chartered accountants, the remittances are allowed. And department is not able, doesn't have the capacity to go in after each and every transaction. But each and every transaction goes through the chartered accountants. So the obligation, responsibility on all of you is very heavy, and has to be carried out in the rightful manner, and keeping in mind the salient points which have been made by Ajay and Rishabh. And you have to be totally alive to the procedural aspect, to ensure that your client doesn't suffer any undue consequences. And it's really nice the way Ajay has explained very, very intricate the issues relating to several of the types of income, which have generated a lot of litigation heat, and has made it sound very simple. I'm sure that if you want to go deeper into that, then in that case, for each one of them will need one session. But summarizing it so nicely is hats off to Ajay and Rishabh for conducting the whole webinar in a very, very efficient manner. And I will be failing in my duty to, if I don't thank the Committee on International Taxation, which has organized this and have ensured that it is carried out in a very efficient and faultless manner. Yeah, Rishabh, over to you.
Thank you, sir.
Thank you, sir.
I think you summed it up all. I was really apprehensive when I first talked with Ajay sir about the coverage on whether we'll be able to do it in the given time or not. But it has been really nice covering aspects from section 195, 115A, the TDS liabilities, 206AA, goods versus services, FTS, FIS. I think more or less everything that relates to a common query day in day out has been covered. And I also humbly thank the Secretary, Committee on International Tax, Aparna ma'am, for organizing this and the whole team of CI Tag to make it happen in a smooth manner in a very short time frame. So I think that last what is left is to thank the participants to be very patient with us. And just for information, we crossed the mark of 250 participants that joined with us concurrently throughout the last 2 hours. So really, really big cheers for them to be very patient going along with us.
Thank you.
Thank you
sir.
all.
Thank you.
Thank you,
Thanks,
SP sir.
everybody.
Thank you,
everybody.
Rishabh. Thanks,
all the
everybody.
participants. Thank you.
Thank you.
Thank you.
I think if someone from
Thanks. I think, there are no words to thank Ajay, thank Rishabh, and thank Committee of International Taxations, and more important, the participants who have heard and who have raised very, very pertinent questions. I'm sure that they must have been benefited a lot by the today's discussion on withholding tax.
Thank you, sir. Thank
Thanks,
you.
everybody. Thank you. Bye.